War starts. Oil supply is at risk. The world gets worse, and the stock market surges. Not a little, not slowly, massively up. While cities are being bombed, while oil supply is collapsing, while everyone is panicking. That shouldn't be possible, unless the market was never reacting to reality in the first place. Because here's the market uncomfortable truth. The market doesn't care what's actually happening. It cares what people bet would happen. And that one sentence changes everything. Daniel, 35, regular job, small retirement, account. Watches the news every night. You're in Ukraine. Oil prices spiking. Economists warning of recession. He's scared, so he does what any rational person would do. He sells. 3 months later, the market is up. Daniel missed everything. Not because he was stupid, not because he didn't pay attention, because he thought markets react to what's happening. They don't. Here's the rule nobody teaches you. The biggest moves in markets don't happen when news is good. They happen when expectations are wrong. That's what moves billions. Goldman Sachs data revealed investors placed 10 times more bets on stocks falling than rising. 10 times. Everyone positioned for disaster. What happens when disaster is already priced in and something slightly less terrible occurs? The market doesn't celebrate. It punishes everyone who was wrong. When everyone bets against the market, they take short positions. You borrow shares, sell them now, bet price drops, buy back cheaper later. Keep the difference until the price goes up instead. Losses grow with every tick. Broker calls, add money or close your position now. Margin call. Now imagine not one person, thousands of hedge funds all at the same time, all forced to buy right now, whether they want to or not. Buying pushes prices up, which triggers more margin calls, which triggers more buying. That's a short squeeze, and it doesn't need good news. It just needs news less bad than expected. January 2021, 140% of GameStop's float had been sold short. When the squeeze triggered, stock hit $500 per share, nearly 30 times the $17 at the start of the month. GameStop didn't go up because people believed in the company. It went up because people were trapped. And when people are trapped, price stops being rational. Hedge funds lost $838 million in a single day. The news didn't move the market. The fine positioning moved the market. The news was just the trigger. Short squeeze, Joven, fast domino, second domino, algorithms. 60 to 73% of all US equity trading is algorithmic. These systems have exactly one question. Not is this logical? Not is this justified? Is this moving? Trend up means buy. Trend down means sell. No opinion, no hesitation, no humanity. Short squeeze pushes prices up. Algorithms detect momentum. Algorithms buy automatically. Prices go up more. Algorithms buy more. Third domino. Options traders forced to hedge, buying the underlying stock, pushing prices up further. 3 dominoes, all falling, none of it about whether the news was good or bad. Now here's the line that will change how you see the world. For decades, people believed markets reflect reality. Economy strong means markets up. War starts means markets down. Today, reality often follows the market, not markets following reality. Reality following markets. When markets crash, confidence drops, spending slows, economy weakens. When markets rally, people feel richer. They spend more, economy strengthens. The market moved first. The economy followed. The tail is wagging the dog, and almost nobody is talking about it. Passive index funds. 19% of US assets in 2010. By 2023, 48%. In 2024, passive funds surpassed active funds for the first time in history. Nearly half the money in the US stock market not analyzing companies, not reading earnings, not making decisions, just automatically buying whatever is in the index. Combine that with 60 to 73% algorithmic trading, and you have a market where the majority are reacting to each other, not to reality. The market didn't go up because things got better. It went up because too many people were positioned for things to get worse. And when everyone is on one side of the trade, the market doesn't follow logic. It punishes consensus. The market isn't celebrating anything. It's liquidating someone because the market isn't a reflection of reality. It's a battlefield of positions, and the price you see is just the result of who lost. If financial media isn't telling you this, there's a reason. Subscribe, because this channel covers what they conveniently leave out.